All right, deep divers, buckle up. Today we're plunging headfirst into the world of cryptocurrency. I know, the crypto market can seem like this mysterious code-driven beast. But trust me, once we peel back the layers, you'll see it's more understandable. And frankly, more exciting than you might think.
Yeah, it's fascinating. The crypto market often feels like a parallel universe to traditional finance.
Exactly. But here's the thing. Understanding this parallel universe might actually be easier than wrapping your head around Wall Street.
Oh, you'd be surprised how predictable some of these patterns can be, especially when we look at what's known as the four-year cycle.
Okay, so the four-year cycle, I've heard whispers about it, something about bulls and bears.
Right, think of it like a financial heartbeat. The crypto market go through these distinct phases, a couple of years where prices are down, a bear market, followed by a year or two of upward trends, the bull market.
So it's like a cosmic dance between fear and greed, money flowing in and out like the tides. But what's driving this rhythmic pulse? Is it random chaos? Or is there method to this madness?
Well, the real maestro of this orchestra is Bitcoin. Every 4 years, something extraordinary happens. It's called the halving. It essentially cuts the rate at which new Bitcoin is created in half.
Hold on, let me get this straight. Every 4 years, the Bitcoin tap slows down, like someone's tightening the spigot on the digital gold supply.
Precisely. Now, if demand for Bitcoin stays steady or increases, basic economics tells us prices should rise. It's like finding out your favorite limited edition sneakers are suddenly even more limited. Their value skyrockets.
Makes perfect sense. Less supply, fame, or higher demand. Prices go up, economics 101. But here's the kicker. The price of Bitcoin doesn't just double after each halving. It explodes.
That's right. Historically, we've seen Bitcoin's price soar significantly more than a simple doubling after each halving. This tells us demand isn't just staying steady, it's growing rapidly.
Wow. Talk about a financial rocket booster. But let's not forget about all those other cryptocurrencies out there. What about those altcoins? Are they just sitting on the sidelines watching Bitcoin steal the show?
Not at all. While Bitcoin sets the stage, altcoins have their own fascinating dance routine, often choreographed by those mysterious figures we call Bitcoin whales.
Whales. Are we suddenly talking about marine biology here?
Haha, no. In the crypto world, whales are entities, individuals or organizations, holding massive amounts of Bitcoin. These whales are like the big players, the ones who can really make waves in the altcoin market.
Okay, so these whales aren't just hoarding their Bitcoin. They're actively shaping the altcoin landscape. How do they do that?
Well, when Bitcoin rallies, these whales are sitting on huge profits. Smart investors diversify, right? So these whales rotate some of their Bitcoin gains into altcoins, hoping to multiply those gains even further.
So they're riding the Bitcoin wave and then strategically hopping onto promising altcoins. That's savvy investing.
Exactly. They either sell some of their Bitcoin directly to buy altcoins, or more commonly these days use their Bitcoin as collateral to borrow money, which they then use to buy even more altcoins. It's like a high-stakes game of financial leverage.
I've started to see how these whales can really stir things up in the altcoin market. But let's bring in the rest of the players. What about those everyday investors, the ones just dipping their toes into the crypto waters? What draws them specifically to altcoins?
It's a fascinating mix of psychology and market dynamics. Newcomers can be intimidated by Bitcoin's price, which can reach tens of thousands of dollars. It's like walking into a Ferrari dealership when you're on a used car budget.
You're looking at those shiny sports cars, wishing you could afford one. But your wallet's telling you to stick to the more affordable options.
Exactly. This is where something called unit bias comes into play. New investors tend to favor assets with lower price tags. They think, if I can't buy a whole Bitcoin, maybe I can grab 1,000 of this other coin and watch it multiply.
It's the allure of potentially bigger percentage gains. If Bitcoin goes up 10 times, I'll be rich. But is it really that simple?
Well, that's where things get tricky. Altcoins often build captivating narratives around their purpose or technology. They promise to revolutionize finance, solve global problems, or create the next internet. These stories can fuel speculative buying, even if the underlying technology isn't as groundbreaking as the hype suggests.
It's a classic allure of a good story, isn't it? We're drawn to narratives that promise a brighter future. And sometimes that emotional pull can outweigh cold, hard analysis.
Absolutely. And let's not forget the role of crypto traders. They thrive on the market's volatility. Riding those emotional waves of fear and greed for profit, they use technical analysis, trying to predict the patterns of human behavior as much as market trends.
So they're like financial surfers, riding the waves of human emotion and market swings.
Perfect analogy. And sometimes these traders get caught up in the frenzy, using excessive leverage, borrowing money to amplify their bets.
It's like playing poker with borrowed chips. The potential for both wins and losses gets magnified. But this can't go up forever, right? What happens when the music stops?
That's the inevitable question. The crypto market, like any market, is subject to the laws of gravity. And that brings us to the boom and bust cycle. It starts with a surge of optimism, fueled by those Bitcoin whales we talked about, injecting capital into select altcoins. They pick projects with compelling stories, innovative technology, or just a really catchy name. This initial pump attracts new investors eager to join the party.
It's like the opening act of a rock concert. The energy's building, the crowd's buzzing. Everyone's waiting for the headliner.
Exactly. And as prices start to climb, the fear of missing out, or FOMO as it's known in the crypto world, kicks in. More investors pile in, pushing prices higher and higher, creating a self-fulfilling prophecy.
So feedback loop. Rising prices create more excitement, which attracts more buyers, which pushes prices even higher. But at some point, reality has to set in right. You can't just defy gravity forever.
Of course not. Eventually, something triggers a shift in sentiment. Maybe a negative news story, a regulatory announcement, or just the general sense that things have gotten too frothy.
So the music stops. The party's over. Everyone rushes for the exits.
Pretty much. And remember those leveraged traders we talked about, the ones
Mhm.
playing with borrowed chips? Well, when prices start to drop, they're forced to sell their positions to cover their debts. This panic selling creates a cascade effect, driving prices down even further.
A domino effect, one falling after another, until the whole structure comes tumbling down. And that's the bust part of the cycle. Ouch. But I imagine some brave souls see this as a buying opportunity, right?
Absolutely. There's a whole buy the dip mentality in crypto. Some investors believe these crashes are temporary setbacks, a chance to scoop up assets at a discount.
So a roller coaster ride of emotions, euphoria, panic, and then a glimmer of hope for those bargain hunters. But it sounds like we've only scratched the surface. Is there something bigger at play here? Something beyond the internal dynamics of the crypto market?
You're thinking like a true deep diver, and the answer is yes. Crypto isn't just about code and algorithms, it's deeply intertwined with global economic forces. And one of the most powerful forces shaping this landscape is liquidity.
Okay, liquidity. That sounds a bit like a financial jargon monster lurking in the shadows. Can you break it down for us?
Think of liquidity as the amount of money flowing through the financial system. When there's a lot of liquidity sloshing around, asset prices tend to rise. Imagine a swimming pool. If you keep pouring more water into it, the water level rises, right? It's the same concept with money and asset prices.
So more money in the system, higher asset prices. Got it. But how does this liquidity thing affect crypto specifically?
Well, when new money enters the financial system, it doesn't flow evenly into all asset classes. It tends to prioritize safety and familiarity, so it flows first into relatively safe assets like government bonds. Then, as confidence grows, it trickles down to riskier assets like stocks. And finally, it reaches the most speculative end of the spectrum, the crypto market.
Ah, so crypto's like the last kid picked for dodgeball.
In a way, yes. There's a lag between when liquidity increases and when its effects are fully felt in the crypto market.
But wouldn't that lag also work in reverse? Like when things get rocky in the global economy, investors get spooked. Crypto's the first one to feel the pain.
Exactly. When bad news hits like a geopolitical crisis or a sudden spike in inflation, investors pull their money out of those risky assets first. And crypto, being at the high-risk end, takes the hardest and fastest hit. It's almost like crypto is hypersensitive to the world's mood swings.
Okay, so we've got these internal crypto cycles, those whale games, the psychology of new investors. And now this powerful force of global liquidities is like a multi-layered puzzle, with each piece contributing to the overall picture. But is there an even deeper level to this? Something driving this liquidity cycle itself?
That's a brilliant question, and it takes us down a slightly more sobering path. Some analysts believe these global liquidity cycles are tied to global debt and a recurring need for refinancing.
Debt, now we're talking about the real puppet master behind the scenes.
It's a bit complex, but think of it this way. Large entities like corporations and governments accumulate huge debts. Every few years, these debts need to be refinanced, essentially rolling over old debt into new loans. But this refinancing process impacts liquidity in a peculiar way.
Okay, I'm all ears. How does debt refinancing affect all that money sloshing around?
When debts are repaid, money is effectively destroyed. It's like taking money out of circulation, shrinking the pool of liquidity. And as that pool shrinks, it puts downward pressure on asset prices.
So it's like a giant game of musical chairs. The music stops, everyone scrambles for a seat. But there aren't enough to go around.
Exactly. And to prevent a complete financial meltdown, central banks and governments often step in, injecting more liquidity into the system by lowering interest rates. Or, you guessed it, printing more money.
So this cycle of debt refinancing, liquidity squeeze, and then intervention to pump the system back up with more money. A bit like giving a financial patient an adrenaline shot to keep the heart pumping.
That's a great analogy. And if this cycle is indeed the underlying driver of those global liquidity fluctuations, it suggests that the crypto market's booms and busts are connected to much larger forces than we initially thought.
Whoa, so those wild swings in Bitcoin and altcoins might not just be about Tech hype or whale games, they could be reflections of this grand global debt dance.
Precisely. And if we want to truly understand the crypto market, we need to zoom out and see how it fits into this bigger economic picture.
It's a bit mind-blowing to think about. But it also makes it even more fascinating. We're not just talking about digital currencies. We're talking about the future of finance itself.
Exactly. And speaking of the future, there are some fascinating predictions about what might be in store for crypto as these global forces continue to play out.
Okay, deep divers, I can sense things are about to get even more interesting. Hit us with those predictions. What does the crystal ball say about the future of crypto in this grand economic drama?
Well, if this liquidity debt cycle keeps playing out, we can likely expect those 4-year crypto cycles to continue, and each one could be even bigger than the last. Imagine those peaks getting higher, and those dips, well, let's just say they might feel more like canyons.
So buckle up, deep divers. It's going to be a wild ride. But it's not just about the size of those waves, right? There are other forces at play, other potential twists in this financial drama.
Right. One intriguing prediction comes from macro analyst Russell Napier. He suggests that as more people realize their money's losing value due to inflation, they'll seek refuge in assets like Bitcoin to preserve their purchasing power.
Makes sense. People want to protect their wealth. And Bitcoin, with its limited supply and decentralized nature, has often been seen as a potential hedge against inflation, like a digital life raft in a sea of financial uncertainty.
Exactly. But here's where things could get really interesting. Napier predicts that this very trend, people flocking to Bitcoin as a safe haven, could lead to governments implementing capital controls.
Hold on. Capital controls, what does that even mean? Sounds kind of ominous.
Essentially, it means governments could restrict the flow of money in and out of their economies. They might try to clamp down on Bitcoin and other cryptocurrencies as people attempt to move their wealth beyond the reach of traditional financial systems.
Wow. So like a financial tug-of-war, a battle between individuals seeking financial freedom and governments trying to maintain control. But what would that look like in practice? Could governments really stop people from buying and selling Bitcoin?
Well, it wouldn't be easy. Bitcoin is by design a decentralized system operating outside the control of any single government or institution. But governments could make it more difficult to access exchanges, impose taxes on crypto transactions, or even try to ban certain crypto activities outright. We've already seen some countries experimenting with these types of measures.
It's a fascinating and potentially scary thought. Imagine waking up one morning and finding out you can no longer freely buy or sell Bitcoin, like a digital iron curtain descending.
It's a possibility we need to consider, and it highlights a crucial point. Understanding the crypto market isn't just about chasing profits. It's about navigating a changing financial world, a world where the rules of the game are constantly evolving.
It's like we're all explorers, venturing into uncharted territory, and we need to be prepared for the unexpected.
Absolutely. And the more we understand the forces at play, the better equipped we'll be to navigate the challenges and seize the opportunities that lie ahead.
Okay, so let's recap what we've learned in this deep dive. We explored the fascinating 4-year cycle, driven by both Bitcoin halvings and those massive waves of global liquidity. We uncovered the strategic moves of Bitcoin whales and the psychology that draws new investors to the altcoin market, and we zoomed out to see how crypto is intertwined with global economic forces, like inflation debt cycles and the potential for government intervention.
Yeah, it's a complex landscape, but it's also incredibly dynamic and exciting.
And even though these cycles seem predictable for now, they might evolve. New technologies, regulations, and global events are constantly reshaping the crypto landscape.
It's a reminder that we need to stay flexible, adaptable, and keep learning.
Exactly. It's not about rigidly following a set of rules, but about developing a deep understanding of this new financial ecosystem, so we can make informed decisions as the market continues to evolve.
Yeah, we're all on this journey together, and by sharing knowledge and insights, we can empower each other to navigate this exciting, ever-changing world of crypto.
Beautifully said. And as we wrap up this deep dive, I want to leave our listeners with a final thought. Knowing how the crypto market really works, with all its complexities and potential pitfalls, might be the key to not just surviving, but thriving in a world where money itself is changing.
Couldn't agree more. It's about financial literacy, awareness, and being prepared for whatever the future holds.
So deep divers, stay curious, keep learning, and ride those crypto waves with confidence. Thanks for joining us on this journey. Until next time.